There was a moment, not too long ago, when everything felt like it was falling apart. Headlines were screaming, markets were bleeding, fear was everywhere. If you opened your phone, all you saw was red. The market is crashing. Sell before it's too late. Run for the hills. And just like every time in history, most people believed it. But let me tell you a story about two types of investors. Chapter 1. The Crowd. The first investor follows the noise. He watches the news, feels the panic, sees the market drop 7% in a month, and thinks, something is wrong, I need to get out. He doesn't have a plan. He doesn't have a system. He reacts. When prices go up, he buys. When prices fall, he sells. And over time, he wonders why he never builds real wealth. Chapter 2. The Observer. The second investor does something different. He doesn't react, he observes. He understands something most people ignore. Markets don't move randomly. They move in cycles. Every single cycle looks the same. It starts with hope, then optimism, then belief. Then comes the thrill, and eventually euphoria. That moment when everyone believes this time is different. But it never is, because right after that comes complacency, anxiety, denial, then panic, anger, depression, and finally disbelief, before the cycle quietly resets back to hope. This pattern has repeated for over 100 years, again and again and again. Chapter 3. The question nobody can answer. So the real question isn't, is the market going up or down? The real question is, where are we in the cycle? Most people answer this with emotions, guessing, feeling, speculating. But the observer, he looks at data. Chapter 4. The Truth in Numbers. He studies something simple yet powerful, the price-to-earnings ratio of the S&P 500. History shows something fascinating. When the market is cheap, truly cheap, returns over the next few years are massive. When it's expensive, returns shrink, sometimes disappear. Right now, the market isn't expensive, but it's not dirt cheap either. It's average, which means something important. We're not at the bottom, but we're not in a bubble either, and that's where things get interesting. Chapter 5. The Hidden Opportunity. Because while the overall market looks normal, some companies look completely different. Imagine walking into a store. The store itself looks fairly priced, but inside, a few premium products are sitting on shelves with massive discounts. That's what's happening right now. Companies like Nvidia, Amazon, Microsoft, Alphabet Inc., Tesla are all being sold off. Not because they stopped growing, not because their businesses are broken, but because fear is dominating the market. And this is where most people make their biggest mistake. Chapter 6. The Great Misunderstanding. When markets fall, money flows into safe places. Utilities, healthcare, consumer staples. The crowd says, sell tech, buy safety. But the observer knows something deeper. He knows that during every major downturn, tech falls the hardest. And that sounds scary until you realize that's exactly where the opportunity is. Because over time, markets recover. They always do. And when they do, the same sectors that fell the hardest rise the fastest. Chapter 7. The Real Game. Here's the truth nobody likes to hear. Wealth is built in discomfort. Not when everything feels safe. Not when headlines are positive, but when fear is at its peak. This is where discipline matters, not emotion. The strategy isn't go all in. That's what beginners do. The strategy is be selective, stay patient, keep cash ready, and invest slowly over time, Because there's one thing nobody can predict: how bad things can still get. Chapter 8. The Warning. There are risks, real ones: geopolitical tensions, oil supply disruptions, global instability. Any of these could push markets even lower. And that's why the observer doesn't gamble, he prepares. He uses a simple system, DCA, dollar cost averaging, not when things feel good, but when things feel uncomfortable. Chapter 9. The Rule Most People Ignore. Not every dip is an opportunity. Sometimes, a stock falls for a reason. There are only 3 reasons prices drop: macro conditions, market sentiment, company-specific problems. Only the first 2? Opportunities. The third? Danger. The observer only buys when the business is getting stronger, but the price is getting cheaper. Chapter 10. The Moment Most People Miss. Right now, we are in fear. Maybe even extreme fear. And historically, this is where the biggest opportunities are born. But most people won't act because fear is louder than logic. They'll wait, they'll hesitate, they'll look for certainty. And by the time they feel comfortable again, the opportunity will be gone. Final thought. The market will not move in a straight line. It never has, it never will. There will be drops, there will be spikes, there will be chaos. But over time, it trends in one direction: up. The question is not whether opportunity exists. It does. The real question is, will you have the discipline to see it when everyone else is too scared to look?